In the book of Road Less Stupid, Keith Cunningham asked the question, how much money would you have right now if you could unwind any three financial decisions that you've made in your career? And recently I asked myself this question as I was calculating my net worth, and the answer for me is at least $10 million. That's $10 million that I've lit on fire through bad investments, decisions, and so on and so forth. So what I want to cover in this video is what those mistakes actually were that cost me over $10 million and how you can avoid those mistakes, and really just stay to the end, because this is what I wish I would have known before I started making any money whatsoever. If I would have known this in the beginning, good God, I would just be on an entirely different level right now. So we're going to cover through three things. Number one, just a quick context and background on my situation so you understand my finances, my business, etc. How I've lit millions of dollars on fire. We're just going to walk through each of those and all of those mistakes. And then what I've learned from those experiences and how I build wealth and invest now. So just for context, if you don't follow the channel, I've had 3 multiple 8-figure companies in the past 5 years. In 2019, though, I was just a sales rep. I did about 400 grand in commissions. And 2020 was my first full year in business. I actually started my business at the end of 2019. So my first full year in 2020, I made about 2 million net. And then 2021, we had a breakthrough success. So we went from basically like 200 grand a month probably to about 2.5 million a month in the course of a year. So like 12 months. And so it was just a complete hyperbolic rocket ship very, very quickly in 2021. And as you can imagine, my income followed, right? So the success was great, but nobody prepares you for that success. So the preparation wasn't. And when you have success and you come into money that fast, it quickly very leads to a lot of dumb and stupid decisions. And all of those decisions I can kind of categorize around these 4 common patterns, okay? And the first one was an extreme loss aversion regarding taxes. So Charlie Munger talks about loss aversion a lot. The easiest way to know how to explain it is that losses hurt twice as much psychologically as the equivalent gains feel good. Right? So like, for instance, if you give somebody in your company a comp structure and then that comp structure ends up breaking, they end up making way too much money and you have to reset the comp structure back down, more often than not, it's a 50-50 shot that they're just going to bounce or the performance is going to go completely out the window because nobody wants to go backwards. Right? Another example is when I was in sales, there was a saying that if you have a comp structure or a bonus structure for a salesperson, and if they hit the certain comp or they hit the certain projections, they can get a Ferrari, they're going to try a little bit harder. But if you actually just give them a Ferrari and then tell them, hey, if you don't hit these projections, we're going to take it away, they'll absolutely just dance, right? They're going to go absolutely nuts. And again, that's because of loss aversion. So as you'll see, and a lot of entrepreneurs experience this in their first big breakout income year where they have to face down the IRS and realize they're cutting a 7-figure check, they'll just end up making crazy irrational decisions because of that. Because that first check that's a 7-figure check to the IRS, it always hurts the worst. The next pattern is this thing I call inflation shaming. So again, in my breakout success year in 2021, that was also the breakout year for something entirely different called inflation, right? I don't know what the actual rate was it 5% or 10% or 15 or 20%, but whatever. Inflation was undoubtedly at an all-time high. And if you were on social media or you listen to the business gurus, they're like, cash is trash. I get cash and then I get rid of it, get rid of it immediately. If you hold on to cash, you're automatically losing 3 to 10% negative return a year. And so naturally what I did is, I was coming in, I was making a lot of cash really fast. And man, as soon as I got it, it was like, boom, it was out. Boom, it was out. And at the time, that sounds smart. I thought I was being smart. But the only thing worse than losing 3 to 10% a year on your investment is losing 100% on your investment. And I did a lot of that. The other thing that's related to the inflation thing is this obsession with real assets. And this is something I want to talk about because with entrepreneurs especially, they tend to have an obsession with real estate and things that are real, gold, real estate businesses, stuff like that, venture, opposed to paper assets, claims, and derivatives, right? Like buying a company through the stock market or the S&P 500 or whatever. And I get why I think that those types of things, businesses, real estate, venture, etc., they feel more high risk, high return. They're more entrepreneurial by nature. But almost always, if you look at somebody who does that just versus the basic S&P 500 returns, it almost never returns better, especially if you're not a top 10%, 5% in the world expert on those asset classes, which if you got, if you made money through a recruiting business like I did, you're not, okay? So that was a big thing we're going to dive into a little bit later. The final thing was what I call operator syndrome. So one of my financial mentors now, who I wish I had back then or I'd have way more money, Jim Do, which you can check out Jim Do from Do Wealth. They're phenomenal. I really wish I was working with them 5 years ago. But he's told me this saying that you get rich through your business, but stay rich through diversifying into passive assets. But you don't get rich through your investing. But for me, I was determined to make my investments active. And there was a direct correlation between how active I was with my investment, whether it was just picking a crypto or picking a stock or picking a property I was going to invest in. There's a direct correlation between how involved I was and it underperforming. The less involved I was, the more hands off, the more index fund related that it was, the better it did. The more involved I was, the more likely I was to lose my money. And that's outside of, course, my core business where I'm actively involved. So that was the final thing. But let's see how this all comes together and how it all played out. So mistake number one was moving to Puerto Rico. So again, I had this breakout year of income in 2021, and probably about 3, 4, 5 months into the year, I started realizing, okay, this is how much money I'm making. What am I going to do about taxes? I'm going to have to pay this huge tax bill. There's no way I could pay this to the IRS. It's not fair. And because of that loss aversion, I just went into a panic mode. And from there was a 4-week time period between talking with attorneys and just being in this panic where I just decided to pick up everything from Scottsdale and moved to Puerto Rico. One of the stupidest things I've ever done. And it was so rushed too, because I was trying to get there before the July cutoff so I could take the tax benefit this year. So in that huge, crazy rush, I was trying to find somewhere to live in Puerto Rico, and I didn't have time to go out and scout out places. So I found somewhere online, talked to a real estate agent. I looked at the pictures. I was like, it looks good. I called the real estate agent, put down a deposit. There was like a 3-month deposit. I get to Puerto Rico. I go to this place and it's like a freaking attic. Nothing is advertised. We're supposed to have furniture, didn't have any furniture, ended up breaking the lease day one. So right there, that was like 30 or 40 grand just out the window. So then I ended up staying in a hotel, which I stayed in the nicest hotel of Puerto Rico. That was another like 50 grand or 60 grand because I stayed there for 45 days. But it was in this small room. It was like, I think there was mold. And frankly, like my health just like fell apart. Like I started to get like tons of anxiety. I was eating like crap. I had to eat out every day, and I was in a hotel bar, so like I was drinking more than it just sucked. And trying to run at this time 2 multiple 8-figure companies out of a hotel, it just doesn't work. Okay, so then while I'm in this hotel, I buy another lease. So it's another, and then this one was more expensive. So I think I put down like 60 grand for a 3-month deposit or something like that with this apartment. And then I got 45 days in, just fell apart, was broken. And then ended up breaking that second lease too and moving back to Arizona, which was one of the best days of my life. I mean, when I stepped foot off that plane and got back home, it was like, thank God I'm here. And so I'll talk about what I learned from that in a second. But between leases, attorney fees, the hotel alone, because what they also don't tell you is that in order to move to Puerto Rico, if you have like if you're a solopreneur, it's one thing. But if you have a big company, you got to set up a management company. It's got to be in Puerto Rico. You got to do all this contractual work. And essentially, like you have to kind of jerry rig your company, unless everybody's local in Puerto Rico, to be able to take a portion of those Puerto Rico tax benefits. So it takes a ton of attorney fees and structures, not crazy, but a good amount, like 6 figures plus. And then I broke all those leases, the hotel, all of that alone was at least 250 grand, not counting what I lost in productivity. Okay. And just a few other things about Puerto Rico in case you ever consider it. What people don't tell you. Okay. And here's the problems with PR is, again, it's supposed to be like a 4% tax rate. Really, at the end of the day, unless all your employees or you have no employees and you're just solely in Puerto Rico and you have no employees or all your employees are in Puerto Rico, that's the only way it's 4%. If not, if you're like me and you have international employees and a bunch of people in the US, between the management structure and the cash flows and et cetera, it ends up being like 10 to 12%, maybe as high as 15%, which we're going to talk about later. With good tax strategy, you can get as low as, like I've paid an effective rate of 20% tax. So I'm saving 10% to live somewhere I certainly do not want to live. Okay. The next thing is it's much stricter rules than advertised. So if you go there, you can't just do 1 year and bail. You have to stay at least 3 years. So that sucks. And then also like there's a common thing where, okay, well, what you can do is stay there for 6 months, go somewhere else for 6 months. And I think there's a little bit of controversy here. And some people do that. From what I talked to with my attorneys and auditors and so on and so forth, is that like that can break the actual tax benefits because it just looks like you're really a U.S. resident. You just do 6 months there. Really, the 6 months you have to spend in the U.S. have to kind of be in different locations, or they have to be sporadic. Like it's the longer you stay in one segment, the worse it is. Not to mention, I lived in San Juan. It was a huge sacrifice in quality of life. Like for me, you make money to have freedom. And what I found myself doing was basically then, after making money and having the freedom, trading the freedom to make more money. But the purpose of the money in the first place was the freedom. So what was I doing? And what made it even worse, if you're a guy, I mean, probably if you're a girl too, being single in Puerto Rico, even worse. Very, very bad. So wouldn't recommend that. And just look at the track record. I mean, I know a ton of entrepreneurs in our industry who've went on to live in Puerto Rico. The track record of them making it 3 years is almost zero. I actually talked to somebody yesterday and he got the 3 years and then left. And he said it was terrible and probably wouldn't do it over again. So I would avoid this just full stop, unless for whatever reason you just really like Puerto Rico, you really want to live in Puerto Rico. The silver lining of all of this, though, is when I was able to come back, it helped me appreciate what I was actually paying taxes for, which I feel like I never really would have fully understood if I never would have done that and came back. So I was very happy to pay 20 or 25% after some tax planning to live in the US, live with good infrastructure, live with, normal people, etc. Not that the Puerto Ricans are bad or anything, but they're just, there's just nothing to do. You're off on this island in the middle of nowhere. You have no friends. It sucks.
Real quick, and then we'll get back to the video. If you need help with any of these three things, either installing a lead acquisition internally in your business, you need new sales reps, and you want sales reps recruited done for you, and also get the sales consulting and sales management help that comes with that. Or if you just want overall business strategies of how you can scale to 8 figures or beyond, go to the link in the description, click that link, check out the video, and then book a call with our team. We'd love to help you with any of those three things. Now back to the video.
The second mistake I made, and this is the big daddy, okay? This one really is what got me. And this is most of all those losses in the 10 million, this is most of this, is creating a personal real estate portfolio. So I was determined, not to invest in the stock market or bonds or any of this boring stuff, not to even do real estate syndications. No, as I'm running 2 multiple 8-figure companies, I'm going to build a really full stack, personal real estate, personally managed portfolio myself. Great idea. So over 2021 to 2022, I acquired, I might budge these numbers, 36 doors. And I think it was about 28 unique properties, but it was over a 12-month period, maybe even less. I acquired these things. There were some days I was closing on 5 in one day. So, I was acquiring these things quickly. And guess what? I did it right at the top of the market. I did all through turnkey companies who basically rehab a property, then sell it to an investor. So they would underwrite the property. I didn't re-underwrite any of the properties. So of course their underwriting was way off. It was all single family homes, which the only way right now, and especially back then, to make a single family home cash flow is for it to be C or D class in middle America. So Missouri in a bad area is what you got to think of. And that's where some of my properties were. Some of them were Section 8 and stuff. So these properties would cash flow on paper, but the problem is one repair wipes out years of cash flow. So I remember, there was one repair that we had on a property that was $7,000. And I looked at the $7,000 and I'm like, it's going to take me 4 years now to break even on this property just off this one repair. And then not to mention, because it's C and D class and it's just based on the areas I was investing in, you'd have squatters in the property, you'd have tons of evictions, you'd have bad tenants. It was constant headaches, constant bottlenecks, all for these properties generating me $100 to $300 a month. Whoop-de-freaking dude. Doesn't change my life at all. So what I ended up doing with those, sold every single one at a loss. Some of these I sold at such a loss that the home value I sold it for didn't even cover the loan. So I had to pay the bank at the close. So not only losing 100% of your investment, I lost 150%. That's pretty bad. You have to really try to lose more of what you even invested. So then we move on to real estate part 2. So I think I'm getting smarter, but you'll see it just gets worse. So then I pivoted to luxury short-term rentals, and I thought this was going to be a good idea. So I acquired 4 of them. They were all between, $1.3 million actually to 2.5. So not quite what I have on here, but $1 million to $3 to about 2.5. So expensive properties. And what they also don't tell you about short-term rentals is you acquire it. Okay, great. But it's unless it's turnkey, which means it's probably not going to work anyways. Unless it's turnkey, it's 100 to, upwards of 250 grand to set up and launch each property. So that's just cash right out the window. I took tons of time to do this, away from my own business, was underwriting all these properties, taking Airbnb courses. I had to underwrite everything manually myself and learn how to do it. I got second and third opinions from experienced real estate investors. And I did actually a pretty good job of positioning the properties uniquely and marketing them well on Airbnb and doing the price algorithm changes and all the things you needed to do. All of that didn't matter because at the end of the day, the interest rates were starting to go up at that time. I kind of caught middle of that interest rate rise. And then also Airbnb went way down. So all of those historical projections ended up being completely off, and all the properties lost money, negative cash flow. And not to mention, they were super intense to manage. Shit was breaking all of the time. So I got to a point where I was screw that, similar to the last thing, sold every single property at a loss. And then also, even one of those had to pay the bank at the close because I sold it for such a loss because I was selling as real estate was just falling at the very bottom, especially Airbnbs. So you think I would have learned my lesson? But no, that's not all. Real estate part 3. So then I'm okay, I'm going to partner with syndicators and private deals. And even worse, I was I'm going to partner with people who are up and comers, who aren't as experienced, so I can maybe put in a lot of money and get a percentage of the GP. So most of these worked out fine to my credit. But the problem is like, let's say I think I invested in about 15 of these. 3 of them, if not have already gone completely under, are going to go completely under. And so even if the 12 hit pro forma, which again, based on the time I invested with the rising interest rates and just, what happened to the real estate market is probably not going to happen. They're probably going to come under pro forma. They won't lose money, but under. But even if I was to hit pro forma, I'd be at a break even or a slight loss. Okay, so I'm not going to make more than the S&P. I have no liquidity. It's tied up for 5 to 7 years or even longer in some cases. And even if those 12 hit, I'm just like right back where I started, and then I did really get hit by the inflation, right? So the lesson here is to do this, and this was better at least. This was better than trying to pick the properties and manage the properties myself. But the lesson here is you have to have the specialized knowledge to really vet the operators and the deals yourself due to essentially the deal and operator concentration risk. Because if you were able to kind of index this and, you had enough money, let's say, to do 50 of these deals, then yeah, maybe 5 would have went under, but those 45 would have really paid for it. But, 3 out of the 12, it's just not going to do it. If you have one not work out out of 5, even if those other 4 hit, it's just going to kill your return altogether of that section of your portfolio. And so similarly around this time, I did get into the mindset of, okay, I'm not going to actively do anything, but I'm going to start doing more private deals. And so I did a lot of venture deals. Almost every single venture deal I've done is at 0 or is likely going to go to 0. The only saving grace I will say I had with venture is I ended up investing a big portion into school. And that was very, very early on. I was one of the first investors after the existing team at consulting.com. And that has done really, really well. So that's kind of made back every dollar that I've lost from at least the venture side of things. Probably not the real estate side, but at least the venture side of things. So this isn't to say, by the way, that like I've lost every dollar that I made and I had to restart all over. Thankfully, I was smart enough to put enough in the S&P 500 bonds, et cetera, to really last me a lifetime. Like I could retire if I wanted, but it kills me that I'd have, 10 million, if not more today, if it wasn't for those mistakes that I made, or if I just held it all in cash. I'd have way more just holding it in cash and eating the inflation than doing all this active investing and all this other stuff, let alone if I just put it all 100% into the S&P 500. So let's get on to the lessons of what I would do now, which, by the way, as you can tell, if you end up taking financial advice from me after what I just told you, you're an idiot. Like 100% not financial advice. But this is what I'm doing now and what I've learned now for the most part. Okay, lesson number 1 is beyond fundamental tax strategy, just pay the taxes. Okay, I'm able to get down to 20 to 30% depending on how aggressive I want to be each year. I've already mentioned Jim Do from Do Wealth. I highly recommend their company. I don't get any referral fees whatsoever. I send all my clients there. They are literally the best. If I just would have listened to them from day one or been working with them from day one, I'd have way more money just by doing a lot of boring stuff. That would have been great. Lesson number 2 is having an index mindset. So this book really is what started shifting things for me. It's called The Simple Path to Wealth. And essentially the whole thesis of the book is the guy just tells you that if you're younger in your career, just put all your money into the S&P 500. Don't do anything else. Just dollar cost in the S&P 500. That's it. If you're older in your career, do like a 60-40 or 80-20 S&P bonds split, because that way, essentially, if the S&P does do a drawdown and you need the liquidity for retirement, you're not going to get hit nearly as hard if you're 60-40 stocks bonds when things draw down. Okay, so a couple reasons this works really well is number 1, the S&P has beaten almost every other asset class for the last 30 years. Like it is like the premium best asset class that I've seen, unless you're very niche in a certain alternative industry. I mean, if you're a private equity professional or you're really good at real estate, that's what you do. Sure, you might be able to beat that. But for the average passive investor like me, it is probably the best asset class. Requires 0 effort. It's completely passive. It's super simple, which keeps you from making mistakes. And then the low cost index funds, the fees don't need the returns, which is a lot of issues with mutual funds, hedge funds, et cetera, and so on and so forth. So we're going to get into this is a huge shift that I've made, and I've actually applied this to tons of other asset classes as well, as you're going to see. The next thing is I index heavy with a boring diversification I index heavy into boring assets with a diversification into uncorrelated assets. So I'll explain what I mean. So I don't do 100% in the S&P 500 now. And the couple reasons I don't is right now the S&P has a really heavy emphasis on the Mag 7. So that's like Google, et cetera, Netflix, Facebook, like the big tech companies. So really that market is Tesla, et cetera. That index is essentially very, very heavily weighted on those companies and whether they do good, bad, et cetera. And so volatility with any of those or disruption with any of those, maybe it's AI, maybe it's anything else, could really create a lot of volatility in the index. And if you look at the S&P 493, which is S&P 500 minus the Mag 7, it really hasn't performed that well over the course of the last couple of years. So that's one of the risks that's very well known. It's also completely US dependent. There's also volatility. Like for instance, if, I'm not looking to retire anytime soon, but if I was, the issue with being 100% in the S&P 500 is that if, like, let's say you're getting into your retirement years and then you have an '08 drawdown and it goes down by 50%, well, like, that's when you need to start drawing off your liquidity and you're forced to sell at the bottom. Or if, like, you're 100% in the S&P 500, you don't have a big enough emergency fund, and for whatever reason you need liquidity and there's a crash, you're kind of stuck. Like, you need to keep holding those assets and weather the storm through the crash. And then also there's behavioral risk in the sense that, like, if you're 100% S&P and something draws down 50% like it did in '08, it's really hard to just watch your ticker just go 50% down, just from like almost like a mental health standpoint. And it just helps you. It is very, very hard not to be able to sell or mess with it or whatever. So that's the other issue. So what I do is you're going to see is still a very, very heavy emphasis on low cost index funds with another emphasis of uncorrelated assets that I basically index through a similar mindset of the simple path to wealth. So again, this is what I was kind of saying here. So I focus heavily on the S&P, but I also focus on the uncorrelated assets. So this is a strategy that's popularized by Ray Dalio, where diverse assets are essentially stuff that doesn't rise and fall together. So they help you weather different economic storms, whether it's inflation, stagflation, recession, geopolitical risks, stuff like that. Like, there's been stuff going on in Iran. Like, some of my investments have done really well based on what's going on there. And ultimately, you still get about the same returns as the S&P 500, but it smooths it out, gives you a lot of better cash flow and liquidity in some instances, and just keeps you out of that one concentration risk. Okay, now, the issue with this is if you diversify into these other asset classes using public equities, like a REIT is a great example, they still correlate. So REITs, even though it's a real estate index, basically, like you could buy an index based on a REIT. Even though if you do that, the issue is that if the S&P 500 drops, even though real estate might not be correlated with that, the REITs will drop too, just because they're in the public markets. So to really get a lack of correlation, you need to go private. But as we talked about already, the issue with private is that there's deal and operator concentration risk, right? So like if you invest in a bunch of private deals, well, you don't really know how to vet the deal, how to vet the operator. And then, some deals just don't go well. So like if you invest in 10 deals, you just might get unlucky, 2 don't go well, you wiped out all your returns. So this is a question, I realized this over the past year. And I've been really trying to figure out, what do I do about this? Because I've known that I need to have these diverse uncorrelated assets and not just be a fully 100% S&P, but I'm like, how do I do it in the private markets without the deal concentration risk? So my strategy now with uncorrelated alternative type assets is to only invest into index-like structures. So these are essentially structures that are like fund-to-fund type platforms, to where instead of investing in a single deal, you're investing in a fund-to-fund across 100 deals, operators, and sub-asset classes. So I'll give you a few examples. So instead of like investing in a single multifamily deal, I don't even do that anymore. I'll invest in like an institutional grade fund of funds that invests across hundreds of deals, operators, and sub-asset classes. So for instance, like, if I only have 500K and there's 100K minimums to real estate deals, I can maybe do a multifamily, a storage, another multifamily, and a commercial. I'm not really well diversified. I might have 2 with one operator. It's just tough, right? Whereas with a platform like this, what I can do is put in 100K or 500K or whatever it is, and I'm across hundreds of deals, hundreds of operators. I'm in storage, multifamily, commercial, etc. So another example is, instead of picking exact crypto coins, basically like the index of the crypto market, in my opinion, is just BTC. Like if BTC goes, it's all going. So I just do 100% BTC. That's it. That's just my index of that market. So I get exposure to that market. For private equity, like, I'm never going to be an LP of a PE fund, most likely. What I do is very similar to the real estate, a fund to fund. So it's across tons of different PE funds, operators, different theses, different strategies, etc. So the downside of this strategy is you sacrifice some returns because it's more derivative, right? Like when you're a fund to fund and you're further away from the asset, you're obviously going to lose more in fees. But the upside is it still does pretty well. It's not going to be as good as the S&P 500, but it's only a point or two below. It's uncorrelated. You have higher liquidity. So with a private deal, you might be illiquid for 5 to 10 years. Usually with platforms like this, you can be liquid quarterly or annually, which is quite nice. You have predictable cash flow, and there's just way less risk of going to zero. Like how Warren Buffett says, first roll of money, don't lose money. Second roll of money, don't forget roll number 1. And so really what I want to focus on with these is the chance of the entire, all 100 going to zero. It's pretty low. So that being said, again, not investment advice, but I'll give you my allocation now of what I do. And before I show it, I just want to emphasize like this is slightly a little bit more advanced and it's something a little bit more for somebody of my net worth. If I could go back, I mean, you could do completely well with a boring 60-40 stocks bonds, 80-20 stocks bonds, or something like that. I mean, if I would have done that, I'd have way more money now than I had, I'd have way more money now than otherwise. So my allocation overall is 40% securities. That's basic low-cost index funds. Then I do 15% cash or cash equivalents. So either short-term bonds, short-term treasuries, or like a money market fund that does like 4 to 5% now. That's just for almost like dry powder and like an emergency fund. 15% is a little high. So that'll probably come down, then I'll reallocate the rest a little bit later. 10% private equity through those fund-to-fund structures I talked about, 10% private real estate, 7% infrastructure, which is again through those fund-to-fund platforms. Same with 5% energy, 4% farmland. Those again are all through fund-to-fund platforms. And then I do 100% BTC for the crypto and the 2% gold, which is owned legitimately physically. So that's basically it. The reason that I really like this strategy, the core engine of it is really just stocks. And then the alternatives are uncorrelated, mostly are a really good inflation hedge. They're really great for geopolitical instability. They do give you moderate cash flow and a store of value. Some asset classes I considered and left off this list is private credit. I think it's great. Like I know of funds that do really well, but it's just not tax efficient. So if you don't need the income, it's not worth it. Same thing with kind of like T-bills and bonds and a few other income producing, even dividend based index stocks. I don't really need the cash flow because I'm still active in my businesses. So I really focus most of my strategy on what's going to appreciate and just get higher returns over the long run. And then venture is a good asset class as well. You could do a similar thing that I'm doing with the fund-to-fund structure or through funds with venture deals. But the issue is with that is I already do enough private investments of stuff that I control to where I have an allocation for that opposed to what I would normally allocate in venture, if that makes sense. And the other thing that's really important to understand with this and why I like it so much is with the cash allocation, the drawdowns, if you look historically at what this portfolio would have done versus the S&P 500, the drawdowns are 50% less severe. Now, you do sacrifice some returns. Like your returns might be 1% to 2% tops lower over a 20 to 30 year time period, which does add up. But it's a smoother ride, far more diversification, less risk, kind of, especially if you've already made enough money to be able to retire, just kind of gives you the peace of mind. If you take out that 15% cash allocation, the drawdowns are like 30 to 40%, but honestly, the returns are almost even or like 1% worse over the 10 year, 20 or 30 years about even. So that's what I'm doing now. Hopefully you found that valuable. Hopefully you understand the mistakes I made in the past. Don't make those same mistakes, and we'll see you in the next video.